Good morning. Good morning, ladies and gentlemen. Thank you all for joining us for today's presentation of the OECD's latest economic outlook. Presentation will be in two parts. First, the Secretary General of the organization, Matthias Cormann, will present the outlook with the Chief Economist, Clara Lombardelli, after which we'll take questions from the media. Just for those here in the room and online, simultaneous interpretation in French is available. We'll ask you to identify yourselves when you pose your questions, either in the Zoom or here in the line. Thank you.
Good morning, everyone. A very warm welcome to this launch of the OECD Economic Outlook. And before getting into it, I'm pleased to introduce Claire Lombardelli to you for her first Outlook as our new OECD Chief Economist. The global economy has begun to improve. We are projecting a recovery over 2023 and 2024. However, at this point, it is a recovery to low global growth. Economic indicators are showing some improvement. However, by historical standards, in the first quarter of 2023, global GDP growth remained at a subpar rate. Business confidence, particularly in service sectors, has improved markedly relative to late 2022. However, manufacturing sectors are still relatively weak. Consumer confidence indicators in major economies have started to recover from the very low levels reached last year, but overall, they also remain weak. The improvements in activity and sentiment come among a lowering in energy prices, easing headline inflation, and better prospects brought on by China's reversal of its zero-COVID policy in December last year. We project global GDP to grow at a rate of 2.7% this year and 2.9% next year. This projected recovery, while almost unchanged from our interim projections in March, maintains the slightly more optimistic outlook that had been predicted and which we are now seeing materialize. But the upturn remains fragile. Risks remain tilted to the downside. We have significant policy challenges ahead of us. There is the uncertainty caused by the global impact of Russia's continuing war of aggression against Ukraine, and also other geopolitical tensions. Gas shortages were avoided in Europe this winter and major disruptions in oil markets did not occur. But we need to remain vigilant as some of the favorable conditions that helped to reduce energy demand this past year, like a mild winter in Europe, may not be repeated next year. And global demand for LNG is also expected to be impacted by a recovery in demand in China. Beyond energy markets, geopolitical tensions are putting significant pressure on the rules-based international trading system, which has been a key driver of growth and development progress over decades. A persistent inflation, the potential impact of the measures required to durably tackle it, is another key downside risk. Headline consumer price inflation in the OECD is projected to come down from 9.4% last year to 6.6% this year and 4.3% in 2024. This expected decline in inflation reflects the impact of restrictive monetary policy, lower energy and food prices, and reduced supply bottlenecks. Wholesale natural gas prices and oil prices are now back to where they were in mid-2021. However, we are yet to unwind the inflation problem. Core inflation is proving persistent on the back of strong service price increases and higher profits in some sectors. Monetary policy will need to remain restrictive to get inflation durably down to target. The monetary policy tightening cycle since the start of 2022 has been rapid, strong, and globally synchronized, and it is working its way through our economies through higher borrowing costs and declines in house prices. While this remains necessary, it could continue to expose pre-existing vulnerabilities, including and in particular financial market vulnerabilities, given high levels of corporate and household debt. Policymakers need to carefully monitor the risk that tighter financial conditions trigger stress in the financial system or in housing markets. For many workers, high inflation has meant real wage declines, although employment levels on the upside have held up very strongly. Our employment outlook, to be published next month, will give further in-depth analysis of the latest developments we see in labour markets. Fiscal policy should support monetary policy in taming inflation, and it should remain prudent to minimise the risks associated with high government debt. Budget deficits and debt levels are both higher than before COVID-19 in almost all countries. Our sovereign borrowing outlook, released 2 weeks ago, forecasts that government borrowing needs will rise in 2023 again, due largely to support measures for households and businesses in response to high inflation. And it also shows that costs for government borrowing more than doubled between 2021 and 2022 and will rise again further in 2023. An important step will be to unwind broad fiscal support and to better target fiscal support measures. The decline in energy prices from their 2022 peaks and recent increases in minimum wages and welfare benefits to take account of past inflation provide this opportunity. This would also help reinforce monetary policy in tackling inflation and help avoid entrenching the undesirable distortionary impacts on production and consumption decisions. While responding to the immediate economic challenges, policymakers must also lay the groundwork for growth longer term, to optimise the strength and the quality of the economic recovery, to boost productivity, including through reforms promoting competition, reviving investment, increasing female workforce participation, and alleviating supply constraints. To address the challenges associated with population ageing and, of course, to secure the green and digital transformations of our economies. Policymakers need to act to enhance business dynamism, reduce barriers to cross-border trade and economic migration, and foster adaptable and inclusive labour markets, including by enhancing skills. The outlook we are presenting today includes a special chapter dedicated to women's economic empowerment, setting out policy recommendations, including on expanding flexible work arrangements, addressing tax and benefit disincentives, and improving access to childcare. It highlights that removing structural barriers and discrimination to realise gender equality must be a high priority to boost long-term economic well-being and prosperity. Because to boost global growth to its full potential, we must draw on all available talent. Closing gaps in labour force participation and working hours could result in an average boost to GDP of 9.2% across OECD countries by 2060, adding 0.23 percentage points to average annual growth. Some progress has been made, but gender employment and wage gaps are declining at a slow pace across OECD countries, warranting further policy measures. Our meeting will be considering a new strategy to drive the OECD's contribution to promoting gender equality as a core value and strategic priority for our organisation. In closing, we need well-designed, well-coordinated policy measures to tackle both short-term pressures and longer-term structural reform challenges. At the OECD, we will continue to support our members and countries around the world with comprehensive data, analysis and evidence-based policy advice to help inform better public policy choices and to help deliver better policies for better lives. And with that, I will now pass the floor to Claire to provide the comprehensive analysis of our economic outlook. Thank you very much for your attention.
Thank you, Secretary General. Good morning. I'm going to take you through our economic outlook published this morning. While the global economy is recovering, GDP growth is projected to remain weak. We see the unwinding of the severe recent shocks of COVID and energy prices, the unwinding of high inflation, and the unwinding of support put in place in response to these shocks. I will start with the overall outlook. As you see with this graph, world growth, the red line, is projected to moderate in 2023 to 2.7% and edge up slightly in 2024 to 2.9%. Excluding the pandemic year, this will be the lowest rate of global growth since the financial crisis. Three main positive factors are supporting growth in our projections. Lower energy prices are helping to bring down headline inflation and ease the strains on household budgets. Business and consumer sentiment are picking up, albeit from low levels, and the full reopening of China is providing a boost to global activity. The world aggregate masks very different growth trajectories across countries, as a disproportionate share of global growth in 2023 and 2024 is expected to continue to come from Asia. As you see from the green line, the OECD economies are expected to grow at a modest pace of 1.4% in both years. The dominating issue in many economies right now is inflation, so let me talk a bit about that. You can see here the overall picture for advanced economies. The chart shows headline inflation, the blue line, and core inflation, the green line, for a typical OECD advanced economy. Headline inflation has been coming down already in many countries, in a large part due to the easing of global energy and food prices, but core inflation is and stays at elevated levels. Core inflation, which excludes food and energy, remains stubbornly high, largely due to services price inflation. Moving on, we can see just how painful inflation is proving to be for many people in many countries across the OECD. Households have to spend an increasing proportion of their budgets on basic purchases, limiting their demand for other goods and services. And so far, wage increases have been relatively modest. So real wages, which are shown by the blue bars here, have fallen significantly in many countries over the past year. In some countries, this is the largest shock to real wages since the 1970s. But wages only show us part of people's experience. Overall, real household disposable income is shown by these orange dots. This accounts for taxes paid and for other sources of income such as benefits, financial assets, and property. Household disposable incomes have been supported by fiscal policy to help cushion the blow from energy prices, though as you can see, there have been substantial differences across countries. The previous chart shows how active fiscal policy has been in response to price pressures. Monetary policy has also been busy. We can see here how monetary policy tightening is working its way through the economy. Following a long period of low rates, monetary policy tightening has been large and rapid. The pace of interest rate rises has been faster than previous tightening cycles, and in many countries, this has been accompanied by a rapid tightening of credit standards. This chart shows the impact of higher rates and tighter credit standards is increasingly being felt through higher corporate refinancing costs. And in the next chart, we see the effect on house prices, with large nominal house price falls in several countries. We've also seen some signs of stress in some financial market segments earlier this year. The bank failures we saw in the US and Switzerland show how investors are reassessing risks as financial conditions tighten. This combination of developments leads us to project global growth in 2023 at 2.7%, with a modest improvement to 2.9% in 2024. These figures are weak by historical standards. As you can see here, many countries are projected to have weak growth, especially OECD countries. So let's move and look at some examples. In the US, real GDP is projected to grow by 1.6% in 2023 and 1% in 2024. Growth in private consumption and investment is expected to moderate in response to tightening monetary and financial conditions and as savings are further depleted. We expect a fall in employment and a further moderation in wage growth. The major European economies have been strongly affected by Russia's war against Ukraine. In the euro area, GDP growth is projected to be 0.9% this year and expected to pick up to 1.5% in 2024, helped by rising real incomes as inflation eases. Private consumption will be supported by tight labour markets, lower household savings and additional spending of just below 1% of GDP under the Next Generation EU programme. GDP growth in Germany is projected to stagnate in 2023 and grow by 1.3% in 2024. In France, real GDP is expected to grow by 0.8% this year, rising to 1.3% next year. Moving to Asia. In Japan, real GDP growth is projected to expand by 1.3% in 2023 and 1.1% in 2024, mainly driven by domestic demand. China is expected to see the sharpest positive shift of growth of any G20 economy this year due to the lifting of the zero COVID policy. We project growth of 5.4% this year and 5.1% next year. The reopening of China has also provided a boost to demand in other Asian economies. Over the past year, GDP growth has remained relatively strong and close to potential in other parts of Asia. GDP growth in India is projected to ease to 6% in the fiscal year 23-24 before picking up to around 7% in the fiscal year 24-25. Indonesia's average annual growth is projected to remain close to 5%, underpinned by stronger international tourism and demand for commodities from China. In most Latin American economies, after a strong rebound last year, growth will slow sharply. GDP growth in Brazil is projected to be 1.7% in 2023 and 1.2% in 2024. Moving to our inflation projections, here there is some good news in the outlook. We project annual headline inflation in the OECD as a whole will fall relatively quickly, from 9.4% in 2022 to 6.6% this year and 4.3% in 2024. In major advanced economies, annual inflation is projected to be close to, but mostly still above, targets by the end of 2024. Headline inflation in the euro area will fall quite quickly, with food and energy prices falling, but core inflation is projected to moderate only slowly, remaining well above 3% in 2024. There are risks to this outlook. Russia's war of aggression against Ukraine remains a large source of uncertainty. The war is first and foremost a humanitarian tragedy. It is, however, also a high potential source of further disruptions to the world economy and continued threat to food and energy security. These charts show selected key wholesale food, fertilizer and energy prices, which spiked up when the war broke out. They have fortunately come back down since their peaks last year, but risks to prices from the war remain. We don't know how the war will evolve, but the potential global impact remains a key source of concern. A substantial risk is that inflation proves to be more persistent, and in response, interest rates need to be higher for longer. Over the past 18 months, underlying inflation has consistently proved to be more sticky than projected by the broad majority of national and international forecasters. This chart shows the share of items where prices have increased by more than 5% for at least 12 months. This share has gone from near zero at the beginning of 2021 to around a quarter in the US and over a third of the consumption basket in Germany. If inflation surprises by being more persistent, inflation expectations may rise to levels well above targets and possibly entrench inflation through greater indexation of contracts and financial assets. To tackle this, significant additional monetary policy tightening would be required, weighing on growth and increasing risks of financial market vulnerabilities. However, with energy prices having already declined substantially, inflation could potentially also surprise by falling faster than expected. Let me turn to another risk, the level of debt around the world. Total debt in many advanced and emerging market economies is high following a general upward trend and recent shocks. On the left panel, you can see that in advanced economies, total debt has increased and currently stands above 250% of GDP. The biggest driver is the increase in government debt, the blue bars, from below 70% of GDP in 2007 to above 110% towards the end of last year. The change in total debt in emerging market economies, shown in the right-hand side panel, is a bit different. Here, most of the increase in debt stems from non-financial corporations, the pink bars. Higher debt increases debt financing costs, and higher government debt ratios may limit policy space for the future. Moving to the final risk I want to highlight this morning. Geopolitical tensions have been on the rise for some time. This graph shows you the share of items under new import restrictions imposed by G20 economies. Restrictions have been rising steadily since the global financial crisis. COVID-19, and more recently Russia's war against Ukraine, further exposed and intensified tensions over trade and security of supply. A move away from the open, rules-based free trading system, which has benefited people around the world in past decades, would lower global growth and make people around the world worse off. So what should policymakers do about all this? First, let's start with monetary policy. We need to bring inflation back to targets. Monetary policy will need to remain restrictive until policymakers are confident that underlying inflationary pressures are durably reduced. This will mean different things for different countries. In the chart, we show the policy interest rates for advanced economies on the left and emerging market economies on the right. The shaded areas show projections. As you can see, policy interest rates in many countries are projected to have reached their peaks or are expected to do so in the next few months. In economies where core inflation continues to prove persistent, additional interest rate increases or keeping interest rates higher for longer may be required. As monetary policy works its way through economies, in 2024, inflation in many countries is projected to ease towards central bank target ranges, potentially providing some scope for policy rate cuts. Moving on to fiscal policy, in 2022, governments rolled out substantive fiscal support to cushion the effects of high energy prices. This support was necessary and prevented a bigger fallout from the economic shock of the war. However, today we're in a different place. In many countries, food and energy prices have fallen or are declining, and minimum wages and welfare benefits have been permanently increased. Fiscal policy now needs to tighten in many countries and better align with monetary policy. Broad-based emergency support, the orange bars, should be withdrawn. However, some households will continue to struggle with cost of living and the cost of living crisis. They will need further support. Policymakers should target that support to the most vulnerable households where they are inadequately covered by the general social protection system. This is a key message, warranting repetition. The orange bars represent broad non-targeted support. That needs to be disappearing. Moving forward, governments need to adapt their fiscal policies to prepare for the future. As you can see on the left-hand chart here, government debt ratios have increased in response to COVID and the war. They are expected to stay persistently higher than their levels before these shocks. Yes, debt levels fell in 2021 and 2022, to a large extent due to surprise inflation, an effect that cannot lower debt sustainably. Elevated debt reduces resilience and limits future fiscal space at a time when many countries are already facing rising spending pressures. Ageing, as shown in the right-hand side panel, means a rapidly increasing share of individuals older than 65 compared to the working age population. Improved life expectancy and medical advances are great developments, but ageing will also increase pressures on budgets through higher related spending and lower revenues. Governments need to take policy action now to prepare for and respond to these changing longer-term fiscal pressures, including ensuring pension liabilities are sustainable and extending working lives. The projections I took you through earlier show economies that are recovering but to weak levels of growth. The challenge is to sustainably lift longer-term growth rates. This chart breaks down growth over the last 50 years in OECD economies. In the last decade, potential growth has halved compared to what we saw a few decades ago. You can see that the main drivers of the decline are ageing, which has reduced the size of the workforce, shown in the red portion of the graph, and even more striking is the fall in productive investment, shown in the green part of the graph. We need to return to higher levels of productive investment to counter the changes in the working age population by bringing more people into the workforce and working more productively. It's not just about ageing. If we turn to employment, a more inclusive labour market would counterbalance labour shortages and enable more people to benefit from economic growth. We can do more to make the most of the available pool of talent. This requires extending employment opportunities to more women, older people, and more people with health conditions and disabilities. Many countries can do much better on this. The chart on the left-hand side shows that women's employment rates still lag behind the rates of male workers. And on the right-hand side, we can see how in many countries it is still the case that women are paid less than men. Policy can change this, promoting affordable and high-quality childcare, flexible working arrangements, improving work incentives, and eliminating barriers to women's entrepreneurship can all improve employment outcomes for women and the economy for everyone. Moving on to investment, the need for greater productive investment, both public and private, in most economies is clear. Falling longer-term growth has been associated with falling levels of productive capital per worker. We need to turn this trend around. Reviving investment will also be important to deliver the green transition, as you can see in this chart. The International Energy Agency showed that clean energy investment needs to triple by the end of the decade for us to be on track to meet the net zero emissions target by 2050. More investment in innovation will also be needed to bring new climate-friendly technologies to the market and reduce their costs to ensure uptake. So to summarise, we see a recovery on the horizon, but there is still much more work to unwind the shocks of past years. If there are 3 policy messages you should take from this outlook, they are: 1, we expect inflation to recede, but the job is not yet done and monetary policy will need to remain restrictive until it is clear that inflation is durably reduced. 2, as prices ease, fiscal support should be scaled back and targeted only on those who need it. And 3, we are returning to a level of long-run growth that is less than it could or should be. We need bold, forward-thinking reforms and international cooperation to raise long-term growth. Thank you.
Thank you, Claire. Thank you, Secretary General. We'll now open up the floor to questions from the media. Please identify yourself. Also, those watching online in the Zoom, please feel free to put your questions through in the chat. First one right here.
Good morning, William Horobin from Bloomberg. You recommend that central banks should remain restrictive and fiscal policy should be prudent. Can you say when the impact of this policy mix would be the greatest? And secondly, given the lag in the impact and the feeding through of tighter monetary policy, should major central banks be cautious in their upcoming meetings or just continue raising rates until they see the real data showing falling underlying inflation?
We're seeing the impact of monetary policy tightening now, as you saw on both the refinancing costs and on factors like housing markets. So we're already beginning to see the impact of monetary policy tightening, and that will continue over the rest of 2023 and into 2024, and that will bring inflation down. As we're saying, it needs to remain restrictive until we see evidence that inflation is durably being returned to target. Of course, central banks need to remain vigilant and weigh both sides of the risk. Obviously, they shouldn't tighten too much and to the point that that would have a greater impact on growth than is necessary. So this is a delicate balance for central banks, but we are today saying they will need to maintain restrictive monetary policy until there is evidence that inflation is durably returning to target, and that means core inflation as well as headline inflation.
Lee Thomas from Reuters. In the same vein as the previous question, given that the full impact of the rate increases is going to be soon felt, is there a risk that central banks have already gone too far? What can you say about that? Thank you.
So we see the balance of risks as being a greater risk from potential further inflation persistence. As we've seen to date through this inflation crisis, inflation has surprised on the upside and continued to. Of course, as I said in the presentation, there are risks on both sides, and it may be as we reach a turning point on inflation, it falls faster than expected. But we do believe that central banks need to maintain the path that they are on of restrictive monetary policy until they see evidence that durably inflation is returning back to target, and that means core inflation, wages, all consistent with the long-term targets.
And I think it's also true to say that central banks are very mindful of the fact that as you go through the monetary policy tightening cycle, that eventually risks are becoming more evenly balanced. I mean, the risk of not doing enough versus the risk of doing too much, something that central banks continue to very carefully monitor. But right now, the mission is to get inflation back to target,
Ángel Calvo de l'Agence espagnole de presse EFE. Sur la question des salaires, vous...
On the question of wages,
presque dans la totalité des pays,
on the question of wages, you have shown that in nearly all countries, there's been a loss in purchasing power. Because wages have not increased at the same rate as inflation. What do you recommend?
une hausse très importante.
Is there a problem if the wages increase considerably? Is that going to increase inflation? Or is the main problem linked with the loss of purchasing power of the working people? And a specific question concerning Spain. You've mentioned, you've increased your projections for Spain. Next month there's going to be elections in Spain, and we've seen in the past that there isn't necessarily an obvious majority to create a government. Does this present any risks, and are you taking in these risks into account in your projections? Another point about Spain is that seems to be one of the only countries for which you do not expect a fall in inflation for next year. Why is that?
Sure. So let me start with Spain. Spain had performed better than the average of the euro area in response to the war, and we have growth in Spain projecting to slow to 2.1% this year and then 1.9% in 2024. We do anticipate that lower inflation and the resilient labour market will support household consumption, as you say, through that. I mean, the economy has experienced quite sizable government support to this point, and of course a full recovery in tourism post the pandemic. So the economy's been very strong in relative terms through this period. I mean, what we are recommending for Spain is that going forward, the fiscal stance does need to be tightened to address high debt. That is, the expectation. As inflation recedes, fiscal support measures, as we're saying for other countries, need to be sort of reduced and targeted better. Of course, one issue for Spain, important issue, is productivity, and the recovery plan should be used to maintain and to increase productivity for Spain, and that's the thing we would recommend there. And of course, Spain needs to continue with its transition its green transition away from fossil fuels. Yeah. On wages, what we have in our projection is, so obviously real wages have been really squeezed during the inflation crisis. What we have in our projections is that will begin to recover now as inflation recedes, and real wages will recover some of the gains that they've lost. I mean, in practice, what that means is for a lot of people at the moment, it may feel like this is in a sense the most painful part, because people are still experiencing very high inflation and real wages haven't kept up with that. But going forward, we expect some recovery in real wages. So this will begin to feel better as inflation eases and people begin to see a rebuilding in their real wages.
Another question here in the room, please, right there.
Hello, yes, Ali Bektawi for AFP. I had a more broader question on investment, development and debt. I wanted to know if the OECD plans to be part of the summit that is taking place later this month in Paris at the initiative of President Macron for a new financial summit. Do you intend to be here, and what are the priorities of the financial reforms you think are the most important to develop the financial aid to vulnerable countries and the energy transition? Thank you.
Well, thank you very much. I mean, the answer to your first question is yes. We will, of course, be there and support the summit that's been organized by President Macron. And I mean, this is a very important piece of responding effectively to the climate challenge and also to the sustainable development challenge, generating the necessary level of public and private financial investment. And I'm very much looking forward to finding solutions to generate the very substantial levels of investment that will need to be generated in order for us to be able to successfully transition to a net zero economy globally, in a way that is globally effective, but also fair and equitable, and also to re-energize the momentum towards achieving the 2030 Sustainable Development Goals. I mean, quite some progress was being made, but the pandemic and the impact of the war of aggression in Ukraine, Russia's war of aggression against Ukraine, have presented very significant setbacks. And this is a great opportunity for the world to refocus on the task at hand and to come up with the innovative solutions to really leverage and to make sure that we have a globally more coherent approach to generate the necessary level of public and private investment, all heading in the same direction.
Other questions? One right here.
Good morning. Richard Yo from Les Echos. In your presentation, you mentioned the low level of growth of potential output and you asked for investment. In that context, what do you think of the American policy with IRA, the EU policy with Net Generation or Green Deal? You think that the solution or part of the solution are public subsidies to improve investment? Thank you.
Thanks. So, I mean, the US is one of the 3 top greenhouse gas emitters in the world. We welcome very much that the US is ramping up efforts to tackle the climate challenge and investing in technology. A successful transition into a greener economy is going to require considerable public investment. So steps that mobilize investment are welcome at the US, EU, and in other countries as well. I mean, furthermore, the size of these markets means that it will help speed up progress in climate technology with potential positive spillovers for worldwide, as it will lower the cost of technology, encourage take-up. I mean, the challenge for all countries is to navigate the complex kind of political and economic pressures to act urgently on this, but also implement economically sound solutions. I mean, there is always a risk that subsidies end up poorly targeted and non-transparent, and marking distorting subsidies should be avoided. But, you know, climate ultimately is a global challenge. It's going to need a global solution, and that's going to need international cooperation, including avoiding distortions in the national and international playing field.
Thank you. Do we have more questions here in the room? Don't see any at this moment. We do have one here that's come in through the Zoom people who are watching online. This one is from Joel Hills from ITV News in the United Kingdom. Is inflation in the United Kingdom looking more persistent than in other developed economies?
Yeah, inflation in the UK is higher and is proving to be higher than in other countries at the moment. It's notably high for a combination of factors. So unit labour costs are high in the UK. You know, the labour market is particularly tight and wages are rising. The UK was also very exposed through its energy mix to the energy price, and that will feed through into other goods as well, and that's happening with a lag. So the UK has experienced particularly high inflation, slightly higher than other countries. In our projections, it is expected to see faster falling inflation and inflation to return in 2024 towards target.
Just a final check if there are any other questions here in the room.
Very good. Thank you.
If not, then we will close this press conference. You'll find all the information online, oecd.org. Thank you very much.